Hey everyone, welcome back to Corporate Decoder, the place where we break down the biggest corporate stories with a wink and a nod. So today we're diving into Rogers Corporation's latest quarterly report, and let me tell you, it's been a bit of a roller coaster with some big news hitting the company hard. Let's get straight to it. Before we jump into the nitty-gritty, if you want more of these no-nonsense corporate breakdowns, make sure you're subscribed and join our Discord community, linked in the description below. Lots of smart folks already there, sharing their insights. Alright, first off, Rogers Corporation is out with its quarterly report for the period ending June 30th, 2025. And if you're looking for a blockbuster, these financials tell a story that's not exactly a fairy tale. The company is facing some pretty significant headwind impacting their sales and profitability quite a bit. So let's talk numbers. The company reported net sales of $28 million for the second quarter of 2025. Now that might sound like a lot, but it's actually a drop from last year when they brought in $214 million for the same period. That's about a 530% decrease. Think of it like losing 1 in 20 customers for this quarter alone. Now, let's dig into the profitability side of things. Their gross margin, which is basically the money left over from sales after paying to make their products, took a pretty big hit. It fell from 34.1% last year to 31.6% this year. That's a roughly 250 basis point drop, which is a noticeable squeeze. This means for every dollar of sales, they're keeping about 2.5 cents less than they were before. This is a pretty strong signal that their costs are either going up or they're having to sell things at lower prices to move them. And here's where things get really interesting. The company recorded a massive $76.1 million in restructuring and impairment charges in this quarter. Now, normally this is a much smaller number. Last year for the same quarter, it was just $1.4 million. So what does this mean? Well, a huge chunk of that $76.1 million, precisely $71.8 million, is an impairment charge, which is a fancy way of saying they had to write down the value of some of their assets. Specifically, they had to admit that the goodwill and other intangible assets related to their ceramic reporting unit within the Advanced Electronic Solutions or AES segment are worth a lot less than they thought. They basically took a big hit on the value of that part of their business. This could be due to tough market conditions, or perhaps their strategy for that particular product line just isn't working out as planned. On top of that, they also took restructuring charges of $4.3 million related to closing down a manufacturing operation in Belgium and cutting jobs globally. This is a clear sign of them trying to cut costs to deal with the tough market. Let's focus on that goodwill number for a second. The fact that they had to write down $67.3 million of goodwill in their Advanced Electronic Solutions segment is a pretty big deal. Goodwill is what you pay for a company or a part of a company above its actual fair value, something like buying a brand name or a dominant market position. When a company has to write down goodwill, it means they've realized that the premium they paid isn't worth it anymore. It's a non-cash charge, but it's a big red flag about the future prospects of that specific business unit. This ceramic OBI reporting unit is clearly facing some serious challenges. And a mill act of a company above its actual fair value, something like buying a brand name or a dominant market position. When a company has to write down goodwill, it means they've realized that the premium they paid isn't worth it anymore. It's a non-cash charge, but it's a big red flag about the future prospects of that specific business unit. This ceramic reporting unit is clearly facing some serious challenges. All these factors combined turn their operating income into a significant operating loss. In the second quarter of 2025, they reported an operating loss of $67.5 million. Compare that to the second quarter of 2024, when they had an operating income of $11.3 million, from profitable to losing money. It's a pretty drastic turn of events and really highlights how much their business has taken a hit. Looking at their individual segments, Elastomeric Material Solutions, or EMS, saw a 5.6% drop in net sales this quarter compared to last year, mainly because sales to the electric and hybrid vehicle market weakened. Their gross margin there also dipped from 37.7% to 35.2%. So even the parts that are doing a bit better are feeling the pressure. Their other segment, which is less significant, did see a slight sales increase and a small improvement in gross margin. But this is a small part of the business and doesn't offset the struggles elsewhere. Now let's talk about their cash situation. Rogers Corporation had $57.2 million in cash and cash equivalents at the end of June 2025. That's down a bit from $159.8 million at the end of last year. This decrease is largely due to them buying back their own stock, spending $28.1 million on share repurchases and also making capital expenditures like buying new equipment. While they still have a decent amount of cash, the drop combined with the operating losses and restructuring charges is something to watch. Speaking of share repurchases, they bought back about 400,000 shares in May and another 19,000 in June, totaling $28.1 million. This is often seen as a way to boost shareholder value when the stock price is low or when the company doesn't have other immediate growth opportunities. Given the current financial pressure, it makes you wonder if this is the best use of their cash right now. Their research and development expenses also saw a cut. They spent $7.0 million on R&D in the second quarter of 2025, down from $9.5 million last year. This 26% reduction is probably a necessity to cut costs, but it can also be a necessity to cut costs. But it can also be a double-edged sword, potentially impacting their ability to innovate and stay competitive in the future. Looking at the stock repurchase program, they still have $76.1 million remaining that they can use to buy back shares. This program has no expiration date, which gives them flexibility, but also means they can continue buying back stock even if conditions worsen. Now for a bit of legal drama. Rogers Corporation is still involved in asbestos litigation and future cases, so what less number of claims has gone down, the financial impact of these cases is ongoing, though they seem to have insurance to cover most of it for now. They also had some executive changes recently, with the CEO leaving in July and other executives following suit. This kind of leadership turnover often signals internal challenges or strategic shifts, and it's definitely something to keep an eye on, although still generating some cash from operations and have a cash cushion. The increased costs and reduced profitability are putting a strain on the financial impact of these cases is ongoing, though they seem to have insurer structure. Back in November 2024, they separated from INOAC, a partner in two joint ventures. Rusty and Rias is of cost-cutting their strategy shimmed Agradis. This involves selling off their stake in one and acquiring the other. While it led to some payments, the key takeaway is that these JV relationships have ended, which no doubt changed how they operate and report their financials in this current quarter. They're in two shining path, with risks to innovation and fresher growth being potential casualties of cost-cutting. Their strategy seems to be about surviving the current downturn and Alright, that wraps up our look at Rogers Corporation's latest. What do you think about these numbers and the company's direction? Let us know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up and make sure you subscribe for more. Also, don't forget to join our Discord server linked in the description for more real-time insights and discussions. Thanks for watching Corporate Decoder, and we'll see you in the next one.